All right, let's jump right into this explainer and set the stage for what is, quite frankly, one of the most incredible financial transformations happening on Wall Street today. We are looking at Apollo Global Management. Historically, they've been known as a traditional private equity firm, but they are rapidly morphing into something entirely different and arguably much, much more powerful. $1 trillion. In the first quarter of 2026, Apollo officially crossed the $1 trillion mark in assets under management. And look, this isn't just some vanity metric we're throwing around. It is a staggering milestone that validates exactly why we need to unpack their strategy today. They're operating at a scale that is fundamentally altering global capital markets. Private Equity Wire recently hit the nail on the head regarding a major shift. Apollo just isn't playing the traditional buyout game anymore. Think about this. They originated a record $309 billion of loans in 2025 alone. They are directly challenging the massive Wall Street investment banks in the $300 billion corporate lending space. Where traditional banks are pulling back, Apollo is stepping right in. To understand how they're pulling this off, we have to break down the Apollo engine. The firm operates across three main segments: asset management, retirement services through their subsidiary Athene, and principal investing. But the absolutely crucial point here is that massive pivot to credit. Roughly 65 to 70% of their total AUM is now credit-oriented. That essentially makes them the dominant private credit franchise globally. Okay, let's de-jargon for a second to really grasp how this engine runs. We need to talk about FRE, or fee-related earnings. If you want to accurately value Apollo, you have to look at the cash it generates. And FRE is that core, recurring cash income they earn simply from managing all these massive funds. This metric grew a massive $5.0 billion in fiscal year 2025, and management is aggressively targeting $10 billion by 2026. Then we have this second earnings engine, SRE, or spread-related earnings. Honestly, this is arguably Apollo's most underappreciated profit driver. SRE captures a highly durable 150 basis point spread between the cost of their insurance liabilities and the yield they actually get from investing that money. This super steady stream generated $3.8 billion for Apollo last year. So how do FRE and SRE actually work together? It's all about what analysts call the Athene flywheel. When Apollo fully acquired the retirement services provider Athene back in 2022, they unlocked access to over $315 billion in insurance policyholder liabilities. We're talking about annuity premiums that continuously fund a massive captive investment vehicle. Unlike a traditional bank that constantly sweats about depositors pulling their money out all at once, this capital is permanent. It's structurally insulated from forced redemptions. Naturally, this brings up a comparison with their biggest rival, Blackstone. Now, Blackstone has a massive $922 billion in fee-earning AUM that leans heavily into real estate, whereas Apollo focuses tightly on retirement and credit, with $322 billion. But here is the wild part. Despite Apollo's fee-earning AUM growing at a blistering 44% last year, compared to Blackstone's 11%, Apollo trades at a significantly cheaper valuation multiple. We're talking 14.2 times forward earnings versus Blackstone's 19.5. Apollo is actively using this cheaper, permanent capital to write massive, highly bespoke checks that other firms simply cannot match. Consider these mega deals. They put together a $35 billion private credit package to support AI investments for Broadcom and Anthropic. They also structured an $11.2 billion joint venture for Intel's semiconductor manufacturing. By structuring these as joint ventures or bespoke packages, Apollo is helping these giant corporations keep debt off their balance sheets. That preserves their investment-grade credit ratings while treating the capital essentially as equity. They are also deploying this patient, flexible capital into complex infrastructure. Using their transition investment framework, Apollo is targeting sectors driven by real economy demand rather than just chasing short-term market sentiment. They're positioning themselves to fund the global industrial renaissance. Everything from energy grids to digital infrastructure, projects that require exactly the kind of long-duration capital Apollo has completely mastered. But hey, with massive investments comes massive risk, right? To protect these huge deployments, Apollo integrates a materiality-based sustainability risk assessment directly into their underwriting process. And this isn't just about optics or good PR. As Apollo's executives note, climate and workforce dynamics are financially material. They directly impact insurance premiums, operating costs, and overall asset performance. It's a highly calculated strategy to mitigate downside risk across the entire portfolio. This incredible execution leads us straight into the bull case, which was recently outlined in an equity research report by the Mingyang Fund. They literally call Apollo a mispriced cash machine. Their base case target price is $155 per share. With the stock currently sitting around $109, you're looking at a massive 42% upside. The Mingyang Fund is so bullish because of the sheer cash-generating power of the firm. When you combine FRE and SRE per share, it grows steadily from 12.4 in fiscal 2024 to 14.4 in 2025, and projections have it hitting 19.2 by 2027. The analysts argue the broader market is just wrongly valuing Apollo based on volatile GAAP net income, which swings wildly due to mark-to-market accounting on Athene's portfolio, instead of focusing on this incredibly steady underlying cash flow engine. But we always have to look at both sides of the coin. If Apollo is generating all this cash, why in the world is the stock trading at such a heavy discount compared to peers like Blackstone and KKR? What are the looming risks keeping the price depressed? What could actually derail this giant? Well, the Mingyang Fund details several core risks. First up is the Epstein-related securities litigation overhang. Regardless of fundamental earnings, this creates institutional career risk. A lot of fund managers simply avoid the stock altogether because of the headlines. Then there's the opacity of private credit. Because these loans aren't publicly traded, their prices are derived from internal models, creating real fears of systematic overstatement. Add in the rollover exposure on $228 billion of short-term investments, plus a broader macroeconomic fear of hidden systemic losses across the entire private credit market. Now, the Mingyang report ran a fascinating stress test on these exact fears. Even in a cyclical correction scenario, where default rates spike to 5%, the implied stock price still sits at $273, which is well above the current 109. It's only in a total systemic crisis, assuming a brutal 15% default rate, that the intrinsic value plummets down to $44. When you synthesize these scenarios and assign realistic probabilities to them, you end up with a probability-weighted intrinsic value of $265 per share. This strongly suggests the market is entirely too fixated on the litigation noise and the 10% probability of a systemic crisis, rather than focusing on the highly probable fundamental earnings power of the firm in normal or even mildly stressed environments. So let's wrap this up with a final thought. Apollo has built an undisputed $1 trillion private credit and retirement engine that is just pumping out remarkable, predictable cash flow. Yet it trades at a historic discount due to reputational overhang and macro fears of the unknown in private credit. So, at $109 a share, are you buying the cash flow or are you buying the risk? It's a fascinating puzzle, and honestly, understanding the data we've walked through today is the only way to solve it.